Derivatives trading involves substantial risk of loss and is not suitable for all investors. Past performance is not necessarily indicative of future results.
So stressful. The world's on fire. Good gosh. I can't look at this, guys. Like, my strategy is you buy it and you hope that you guys got it. Yeah, but we all think you're crazy. You don't fight this. No way. The markets are freaking out and you don't think that anything is wrong? Go back tomorrow and I'll lose it all. Should be fun.
Good morning, everybody. Welcome. And today we've got ECB. So should be, we just get more interesting tomorrow. We got CPI. Seems like the market has been ranging and just kind of chilling, waiting for these two big pieces of news. So we're likely to get a bit of volatility today. I personally still kind of holding off on taking on much risk because I keep getting woken up in the middle of the night by a screaming baby that thinks it's dying because, it's been 3 hours since 8. So we'll come over here to the charts. Yesterday, we had like a big move, initial move down off of the open that was then retraced back up. And now we're seeing the same thing today, although today they're getting much lower and they're starting to, they're already starting like below the 7th lows. So there is a possibility here that we go for like new yearly lows, right? Today. It could happen today. I mean, ECB generally is going to be a hawkish thing. I'm likely to see higher interest rates as a result of this. So today might be when they just go for it, right? S&P 500, on the other hand, doing okay, but there was a little bit of a sell-off yesterday. It's still ranging here, so we see where they'll go. Hopefully that resolves itself by the end of the week because the market's just kind of been going sideways and been kind of a little boring. There's natural gas, oil. Oil's still on an uptrend, though. Very steady uptrend. Gold and silver, not so hot still. Kappa is looking, I don't know. I'm kind of starting to think that the fundamentals for copper look good. But is this the best prices? I don't know. I guess anything, you're pretty unlikely to get below 4. So now we come over. Let's take a look at Bitcoin and the dollar. Bitcoin still seeing some like BARTs and everything. There are big players out there taking positions. Not a lot of liquidity in the market, but nothing decisive either direction. And the euro is seeing a little bit of a rise here today. I think that would be expected with the ECB coming out today and talking about ending their asset purchases and raising interest rates and so forth. We're seeing a little bit of dollar weakness this morning. Good morning, Khadija Najmi. That's a new name. Welcome. How are you doing? Let's see here. We got everything. I did not set the video to public by accident. I keep making that mistake. Okay, well, we did have a little bit of an initial. So this move down started. I think it started back when the ECB pushed out their release, right? Yeah. ECB interest rate 5.45 was when we had the big move down. So it's questionable whether that will continue. So far, here in the regular session, it's kind of been coming back. Hey, Steven, how have you been? Haven't seen you a few days. Actually, it's been longer than that, hasn't it? Or is it you just switched your name? You were here earlier in the week, weren't you? Yeah, I think maybe you just switched your name. The Greatsman? What? Oh, man. The hairs on my beard are starting to poke me down here. I think it's about time to trim things up. Ant Group. Oh, so something that happened overnight was there was like a rumor that Ant Group was going to do an IPO again, but then they said no, that's a rumor. Pedro, how's it going? What are you up to? Wait. Is this the Pedro? I think it is. And it kind of, I mean, I can't. You have a picture there. I can't see, but I think that is you. How are you? Are you a crypto analyst now? You made this mistake of rolling into September NES. That's what I did. No, wait. I haven't. Wait, why haven't I? Oh, you know what? I did. I haven't rolled my DOM over. Okay, let's fix that. ES09. Oh, we don't want the CBOT session. We want the CME indexes session on that one. And MES. It is. Oh, very good. Wait, so do you still are you a crypto analyst on your own, or what are you up to these days? That's very interesting. Yeah, we'll do this one. CME indexes too. Why not? Why not? Everything is low with crypto. Didn't see anything on it earlier. Huh. Okay, so now we got the DOM. Oh, I see why you're saying you made a mistake. This is the liquidity in September for ES, at least, is not very good yet. We kind of saw this last time, right? Wasn't it like that was kind of sucky until the open? You still trade? I just the cryptocurrency market is at a fair valuation, I would say. I wouldn't say that it's low. I'd say it's actually like we've just come back to the upper end of fair. But the thing is for it really since 2017. Well, not 2017, but really since like 2018, they've never gone to a fair value. They always pump it up before that happens. I fear though that this situation might be different, because even though the value is fair, there's a lot of headwinds in the cryptocurrency space, right? There's still regulation is coming for sure. There's still the inflation problems, right? Although, if that CPI number tomorrow is good, and I think that it's probably going to come in line with the analyst expectations, that could be a real boost in the short term for cryptocurrencies, at least. So, yeah. I don't know, man. I had this whole plan for like it's gonna get low, and I'm just gonna buy ETF out of it. But I'm really bothered by when I see fraud in markets. There's been a lot of fraud, not just in the cryptocurrency space. It's really been everywhere. You go on TikTok, every Tom, Dick, and Harry has some affiliate. Well, not affiliate thing, but some sort of course or something they're trying to sell, and probably the vast majority of them not worth what people are asking for. It's just, and the cryptocurrency space, the abuse has just been absolutely rampant, and I just don't like it. I just don't want anything, because I could have spent a lot of time here on the channel pushing cryptocurrency stuff, and it probably would have helped the channel, but that's just not the audience that I want. This is not the thing that I want. I'm more interested in, the serious interest rate world, like I like that. I like to focus more on interest rates because it's serious, and I know that the people that are watching it are serious, and understand economics to some degree. And oh man, I've had a couple of experiences lately on Reddit and so on and so forth where I'm just like, some people. Something that really bothers me is when I see people, they have opinions on economics that are very clearly informed by their political ideology and not from actually like understanding the economics, you know? Two days ago on Tuesday, it was an anarcho capitalist. So it was a far right libertarian type of person. And then yesterday it was a far left woke person pushing the whole, we're only seeing inflation because companies, you know, just happened to decide to raise prices, which I think is just hilarious. You know, they always listen. Companies always try to maximize their profits. You know what? I shouldn't be yapping so much because the ECB is going to be going right now, right? Where is it? ECB Governing Council press conference. I'm going to turn her on and I'm just going to keep her really low here.
That those conditions have been satisfied.
I just kind of noticed there was a little bit of a tick, but it wasn't like anything significant. I was like, oh, well, somebody taking a trade in the ECB press conference.
By 25 basis points at our July monetary policy meeting. Looking further ahead, we expect to raise the key
far-right libertarians
again.
But they do. The libertarian is a political inclination, right?
Will depend on the updated medium-term inflation outlook.
It's trying to call a libertarian far right though is kind of a little weird, right?
A larger increment will be appropriate at our September meeting.
People don't even get it most of the time. They aren't even educated on basic economics.
Based on our
Yeah, I mean, I have a really hard time wrapping my head around that kind of stuff because the further along into this YouTube channel that I get, the more I realize that there's a lot of things that I just know, and I'm not even 100% sure how I know them, and they're things that most people don't know. And I'm not sure if it's like, is it something that I picked up when I was at the firm, or did I just know, or like, how do I know this stuff? You know?
Flexibility will remain an element of monetary policy whenever
like, especially when I was running through my Series 65 book, almost everything that was in there I already knew. Almost everything that it was just like the numbers, like how many days it takes for a license to take effect and that sort of stuff. This is memorizing all those numbers, but most of the real content that would be like useful to investors and stuff, already knew it.
Monetary conditions. Looking at the economy,
Because there's no. Well, okay, so like the reason why it's weird to call a libertarians far right, even though I think that in the political scheme of things that is kind of what it is when you look at the far right, you've got the Christian right and you've got the libertarian right. Is really the way that I think about it. But the libertarian calling it right is a little weird because the right generally kind of suggests you want to keep things the way that they are or return back to a past way of doing things. And I guess maybe in some respect you could call libertarian wanting to go back to a past way of doing things, but it's really they want to go so far back that it really kind of becomes a leftist radical kind of a proposal. You know, like it's a really big change, one that probably wouldn't be very good for the economy.
Fiscal policy,
but within the political spectrum, that it does tend to be more right wing.
Protect those people bearing the brunt of higher energy.
But especially these ones, like I have to say, like there's one thing where it's like libertarian. I think there's a lot of people that are just libertarian because they feel that the government has infringed upon people's rights too much and that the Republican Party hasn't done enough to push back against it, right? But they're really still just like Republicans, right? But there's this other group of people, and I, you know, like anarcho-capitalists, right? And these are the people that really firmly believe that like the government should just be completely hands off with the economy. shouldn't be a Federal Reserve. There should never be any kind of stimulus. The government shouldn't impose any kind of regulations whatsoever, and companies just do what they want to do.
Levels 1 year ago.
I'd say it's quite a crazy, but there's a group of people out there, and they are super loud on Reddit.
But will then moderate to
So you try and have like a reasonable conversation about capitalism in a pro-capitalism sub, and then you're gonna get the anarcho-capitalists come out, and it's just like, this is why we can't have nice things, guys,
of agricultural
because the discussion always gets derailed by the anarchos.
supply bottlenecks and because of recovering domestic demand, especially in the service
But I don't know.
as our
I find the far left
are becoming
state of things more disturbing in the long run, because
accordingly measures
what happened on the far left is basically they had this idea of how the economy worked,
continues to improve
and then
unemployment remaining at its
a set of circumstances arose that basically completely contradicted and disproved everything that they believed.
show that
And instead of trying to come back to reality and saying, oh, hey, maybe these economists actually did know what they were talking about, they're trying to come up with every kind of crazy reason they can to justify why they're still right in the face of every piece of evidence showing they're wrong.
measures of
You know?
term inflation
And I just can't stand that.
derived from financial
For the record, I am not libertarian, not sure what I am. It seems to me subjugating my identity to the identity of a group ideology would probably be a poor decision on my part.
signs of above
But yeah, I mean, I think to come in and to mark yourself with an ideology is generally not a good move, right?
assessment
But in order to have success politically, you do have to associate with parties. So
declined, but the war continues to be a significant downside.
who is their truth?
In particular, a major risk could be a further disruption in the energy supply to the euro.
This whole conspiracy theory thing that companies raised prices and that's why we're getting inflation is just such a load of bullshit.
If the war were to escalate,
It's like, oh no, everything that we're saying is true, except for that we have to control companies, and
could increase,
no,
and energy and food costs could remain
so we can print forever. We just have to implement price controls to prevent people from raising prices. No, what you do that, what will happen is your currency will collapse.
The risks to the medium-term inflation outlook include a durable worsening of the production capacity of our economy, persistent energy and food
You print a bunch, you prevent the companies from being able to make up for how much money you printed by raising their prices, then they're just going to take their money to a different currency.
were to weaken over the medium term. It
Sierra chart or Ninja for order flow?
on prices.
Well, I think that
Let's have a look.
Sierra chart may actually have a slight edge in terms of like the tools that it comes with in terms of order flow.
In response to the changing outlook for
Personally, I think that Ninja Trader has a bit bigger,
interest rate,
better ecosystem. I guess the thing, Dande, is that
and this has into
order flow is not really the selling point of either Sierra chart or Ninja Trader, right? If order flow is your thing, then what you really want is Jigsaw or
working capital
Bookmap,
against
right?
the backdrop of increasing production costs, persisting supply bottlenecks, and lower reliance on market
Trying to find a setup that has an edge. Can you help? I mean,
households.
I have a lot of information on this channel that
Robust demand
teaches you about the nature of the markets, and that should give you some ideas about where to search for edge. And I have a lot of videos about how to develop an edge and, like test it and so forth. But I'm not gonna just give you one.
has worsened
But the biggest key I can tell you is that the market is more statistically efficient than it is informationally efficient. So what I would be looking for is,
risk-free rate
how can I understand the things that move the market as well as possible, rather than looking for some technical analysis setup that you can take every day.
At the same time,
Right.
tighter financing conditions could reduce some existing financial stability vulnerabilities over the medium term.
Anyways, there's talk the narrowing spread between the 5 and the 10-year may be indicative of a slowing economy.
Are now facing
Yeah, I don't know, live action. I still kind of feel that the yield curve being so flat
prudential
to begin with
the first line of defense
is really kind of like
financial stability
a factor in here that
liabilities.
I think makes it really difficult to use the yield curve essentially as some sort of
Aggression towards
signal of a recession.
severely affecting the euro area economy, and the outlook is still surrounded by high uncertainty.
No, options expiration isn't this Friday, it's next Friday,
And to recover
right?
further
Next week's going to be a big week, so we're going to have the third Friday, right? So we will have options expiration, but we're also going to have the Federal Reserve next Wednesday,
sometime.
right? So there's going to be a lot of craziness because all of these options players are going to roll their volatility over to the next month. And you're going to see decent amount of gamma probably expire that weekend too.
The calibration of our
Sierra seems difficult for new users. Yeah, well, the thing, Donde, about Sierra charts, here's let me try and put it in like a flavor the context for Sierra charts a little bit.
within
Here,
our
wait, let me blow my nose. It feels a little wet here.
flexibility if warranted to ensure that inflation stabilizes at our 2% target over the medium term. We are now ready to take your questions. Thank you.
Thank you, President Lagarde. And the first question goes to Caroline.
So the thing with Sierra charts was it's written in C++. So supposedly it should be more resource efficient. Okay. Doesn't use as much memory, for instance. Okay. I don't think I can say that it appreciably or noticeably processes data faster, but it uses less memory. And,
start doing the same.
So that's like their basis. It's all written in C++. And then what they did was they anytime that another platform came out with a feature that was, popular, worthwhile, people wanted to have, Sierra charts would poach it. And that's literally what it is like all of their cool features in the DOM, they stole from Jigsaw essentially.
The governing council
And every time that they do that, because these features were not like envisioned from the start of the platform, right? It's just like, okay, here's our platform. People want this new feature. How do we find a way to add it in? And so what that results in is a user interface that doesn't make a whole lot of sense. Like where the settings are and how to get it to look or behave the way that you want is like a complicated thing because there's so many settings within it. And that's why people say that it's not very it's difficult to use for new users, right? It's because of that. It's basically like
over the medium
they've stuffed every little piece of bloat that they possibly can in there because their whole thing has been
was, as we
copying features from other platforms, right?
that we had
This is why I say if it was between Sierra charts and NinjaTrader, I prefer NinjaTrader because what you get with NinjaTrader is you get like a really good ecosystem, right? If it was between Sierra charts and Jigsaw, take Jigsaw because Jigsaw are the ones that are actually coming up with the features, right? Like you get new stuff in Jigsaw and they're always constantly pushing the space, although it's been taking them, their development has been really slow up until this year. So, that kind of sucks. But
on the issue of the
they're the ones that are going to come up with the new feature. And then Sierra charts, you can maybe get it a year later after they somehow find a way to stuff it in, right?
move, but a series of
So that's kind of my view of it.
depending on the
And then there's Bookmap. Bookmap is not the same thing, but Bookmap has come up with their own things. I think that they really, how do I say, they came up with their innovation was the Vista chart, which Jigsaw then came and copied, which is kind of funny.
doing with
But I don't know if the things that you get from Bookmap, at least for me here in Treasuries, really make much of a difference.
monetary policy,
And you're using Java to program, so you don't get the great ecosystem.
the entire euro area. And to that end, obviously, we need to make sure that there is no fragmentation that would prevent the adequate
Getting a good base.
transmission throughout the entire region. We have
So the movement of the cryptocurrencies here this morning is kind of interesting because there's a rise, then a decline.
reinvestment capacity,
Then for pros, there's CTS.
which is
Oh, I forgot about that one.
a complete reinvestment package that totals 1.7
So
trillion.
I don't have a whole lot of experience with CTS, except for that I had a couple of people that wanted to do more algorithmic trading with the order flow based stuff, and so they thought that those were, you know, ATAS and CTS and all those platforms. They kind of tried going in that direction, and they found that their APIs were limited them in one way or another, and that it was easier and better to do things in NinjaTrader. So I don't know. I think the reality, Lucas, is that for a true pro retail trader, which like, is there really actually any such thing? But like the next step isn't really there. The one that I do think matches up is trading technologies. And trading technologies, it's not because it allows you to do anything like with their tools that you can't do anywhere else. But I think that the advantage that you get with trading technologies is that it supports all of the advanced kind of stuff. Like you can actually get access to the bond market, euro dollar. Like if you know, for instance, our friends here that are trading euro dollars, they're doing that through trading technologies, right?
Discussions in Amsterdam. And these discussions concluded.
And TT has a decent enough programming setup that, especially when it comes to like trying to automate like order types, like if you want to make your own iceberg, for instance, TT is really great at doing that sort of thing, right? But I don't think it's the next step. I think that the next step would be a platform where it was written, the charts are written in an advanced language like C++ or Rust or something like that. The platform and the execution is written in that stuff. But the ecosystem is Python. The ecosystem is Python. I think that would be the game changer. And if the ecosystem was Python and there was a built-in hooks, I guess you could say, for you to be able to utilize machine learning models very easily within the platform itself, that would be a game changer. You can kind of do it with NinjaTrader 8, but it's a bit of a mess. It's enough of a mess that I've only messed with it a little bit and I haven't taken it all the way yet.
Do the whole paragraph actually, because it's a really important one. So we undertook a careful review of the conditions, which according to our forward guidance, you all remember the forward guidance with the three conditions, should be satisfied before we start raising the key ECB interest rates. Well, we concluded that these three conditions were...
Anyways, I guess the gist of it is, I think that there are places where platforms could improve.
Sequencing, for those of you who wonder why we didn't do it today, well, we have a sequencing in place that dictates, and we want to be predictable on that front, that we first of all stop net asset purchases and then we look at interest hikes.
On the other side of that, your platform's probably not the thing holding you back, right?
25 basis points.
I think that platform, a lot of that just comes down to personal preference.
That's the September that you
but
were asking me.
I think you need to have a good DOM.
We expect
But if you have a good DOM,
ECB interest rates again.
you can place orders on your DOM.
Calibration.
Beyond that, I don't think that the platform is the thing holding you back, right?
Medium-term inflation outlook.
As for gas, buddy, the national average for gas has reached $5 per gallon.
Increment will be appropriate.
Do you know that in many places now the price of gas is now so high that it's basically, it costs more to drive into work than what you make from going to work?
Or even deteriorates, which of course we don't wish, but it could happen, then obviously the increment will be higher than 25. And then we go further because we take a third step along that journey to indicate what we will do beyond September, which is also the anticipation that further rates hikes will be necessary on the basis of the data that we collect. Thank you.
Thank you, President Lagarde. And the next question goes to Bart Meyers of Reuters. Bart, please. Here. You get a microphone. Yeah.
Thank you, Bart Meijer for Reuters. So just to make that perfectly clear, follow up on your last answer, does that mean that if the inflation outlook is not cut back down to 2%, that we will see a 50 basis point increase in September? And secondly, on the fragmentation. No, sorry, I lost that question. What I wanted to ask.
Take your time, you will find it.
Yes, no, that's all right.
Take your time.
That you wanted to increase the rates by September. Does that mean all 3 rates? Thank you.
Yeah, that's a good question.
It's kind of weird to me to see them like they're doing this press conference.
Because some of you
They're
comment on the fact that I read
all in person, you know.
read it a bit because it matters and every word matters, including plural versus singular, to your point. So what we say is, looking further ahead, so today we say that, we expect to raise the key ECB interest rates, the 3 of them, again in September, most likely. The calibration of this rate increase will depend on the updated...
There's a decent amount of volatility out here right now, but it's not
If the medium-term inflation...
not action I want to get involved in.
...or deteriorates, a larger increment will be appropriate at our September meeting. So I think
It's a platform. CTS is a platform.
if
It's a Java platform, if I recall correctly. Oh, no, actually, no. CTS is C Sharp, isn't it?
beyond, then the increment adjustment will be higher.
Could be wrong.
Yes.
Thank you, President Lagarde. And the next question goes to Annette Weisbach of CNBC. Annette, please, here in the middle.
President Lagarde, thank you very much for taking my question. I have one on what are you expecting in terms of time lag? If you raise rates in July, what do you see an effect on inflation?
I have to say, like, I think that there are some things that the platforms don't do. I think that I could probably start my own business writing a platform. You know, I would have to find funding and I would have to find new programmers. I think I would probably want it to be locally here and could spend my whole day programming stuff in the platform and stuff. But the thing is like the things that I would improve, right? Do they provide such an advantage that like people wouldn't be able to ignore it? Everybody would want to come over to my platform? No. Like it's still an extremely competitive space. All of the things that would get me to move over and that I think are missing. So I think that there's ways to differentiate yourself, but it's a competitive space. So I don't envy the people that are writing platforms. You know what I mean? Because it's not an easy business. And like your ability to iterate through the development process quickly and efficiently and, you know, do it well is probably a larger impact on your success than what your features are, right?
In relation to inflation itself. So we have to stay the course, be determined, committed to delivering the 2%. But we can...
I got it here, right here. They keep poking me.
22nd of August for a decision that...
Is learning to read the DOM time... Oh, yes, very much so. Because... I think that like learning so for instance, I have the video about the stylized behavior of markets, and the book that I talk about in that video, it's a pretty big book, like, and it's a complicated book. It's going to take you some time to go through it, right? But you could come out of that and you could say, well, okay, now I know everything about the DOM. But there's this other side of the DOM, which is you just kind of get a feel for it, and you get a feel for your instrument. How much that helps is hard for me to quantify, but you can tell that I will definitely have an inkling about the way things are going to play out to some extent. And that only comes from watching it every day. So it is time consuming. Well, we're talking about coming in, watching it for 2 hours a day, every day for years and years and years, right? And it provides some edge, I would say. Probably that on its own, probably not enough to make you profitable. Again, because the market is more statistically efficient than it is informationally efficient. So you're never like really anything that you can find here through trading is going to pale in comparison to edges that you can gain through informational inefficiency, right? Informational asymmetry, let's say.
No illusion on that. Thank you.
Thank you. And the next question goes to Dan Ballacher of Volkskrant. Dan, please.
So
Thank you for taking my
it's
question.
time consuming. Like really, DOM trading is really like the hardest way to do it. But I also think that it's going to be the best.
It seems like the ECB would have stopped the purchases earlier if not for the promises made, even though there was an extraordinary inflation-inducing event like the war in Ukraine. Is the tail, financial markets, not wagging the dog, the ECB, instead of the other way around? My second question is related to this one. The ECB believes inflation will fall down back to target by 2024. But for most of the past decade, the ECB also consistently thought that the inflation rate, which was then too low, of course, would converge to its target, and that also didn't happen. So how firm are your beliefs that you are going to succeed now, as historical experiences do not imply great credibility?
This is not enough on its own. What would you say is the worst thing? So I think that there's the parts that I would identify here are like, first, you want to understand the stylized behavior of markets. So you want to go through my order flow series, basically, right? And then you want to sit and spend some time learning the DOM, right? Next thing that I would do is not next thing that I would do.
And if you look at the third paragraph on the first,
I'm like going through here, like, well, what would be a better way of doing it other than just telling you to watch all my videos? But the here's let me approach it this way, Dande. The thing that people don't know that they should that's going to give you the best bang for your buck is understanding your instrument. Okay. I think part of that is because everybody wants to trade it the ES, right? It's kind of hard to gain an edge on ES because it's this conglomeration of a bunch of different stocks. And so, like, are you going to go through all 500 stocks and determine what's going on in each one of those and then use that to figure out where the index is going to go? It doesn't, it's kind of hard, right? But there are some things about it that you can do. Like, what is the difference between the index and the cash? Essentially, right? What's going on with the options? Essentially, right? There's different kinds of strategies. Who are the participants in your market? They're coming in, they're hedging with ES futures. What are they hedging against? What's their strategy, right? One thing I'll tell you is that there's a lot more activity at the beginning of a contract, right? Why is that? It has to do with they want to take a position right at the beginning of a contract and just keep themselves hedged through the whole thing, right? So these are market makers hedging their exposure. You want to like study those sorts of things, right? But yes, it's kind of hard to pull that out. In treasuries, it makes a lot more sense because now you're coming in and you're going, okay, like what kind of corporate issuance is going to happen that day? What is the interest? What is the Federal Reserve saying? What's going on with auctions? There's all of these different peculiarities about that specific market that not everybody knows, but and that's your advantage, right? Is that instrument. You are aware of essentially every force, or the goal should be to be aware of every force that is going to come in and move your instrument in that particular day,
All
right?
international institutions
That's the thing that people don't look at. They just want to come in and look at the chart.
made the same
They don't want to understand their instrument. Like
under
their whole thing is like, I want to know as little as possible.
the developments such as
Right. This is just not how it works.
crisis.
You want to understand your market. And then that also means understanding the
We are the only
macroeconomics of it, where the economy is going in general, what the current news is, how people feel about it, what are the different opinions in the markets, so that you can kind of understand when a piece of information comes out, how is that going to change people's opinions, right? You can look at how the market was positioned and what they all believed and how this changes what they believed to sort out, how many orders are going to come out of that or try and estimate it, right? Those are like the informational inefficiencies. So that's the thing that I would be looking to, where I think that a retail trader can really gain a significant edge that most retail traders don't do.
they can.
How to go through on like a step-by-step process
Other international institutions,
is kind of
events that have
probably beyond the scope of like what I can teach you here in a live stream. But I have a lot of videos about this stuff, right?
of us all.
I have a lot of videos about like, here's how you program something and try and test a statistical edge, right?
And fourth, we
But
do the
really, the informational inefficiencies, there's a lot more edge available for you there,
continue doing so in
right?
the future.
It's just the downside of that is it's not consistent. It changes every day, right? And you have to be continually ahead of the curve on that, right? Right now in the treasury, I don't feel like I'm ahead of the curve. I feel like there's a lot going on here in this market that I must not be aware of.
The flow.
But it's also summer.
Now
Kind of sucks during summer.
To reinvest, especially the PEP payments, principal payments, at least until the end of 2024. That means a huge monetary stimulus for years. Is that appropriate if you, at the same time, are talking about normalizing monetary policy?
I don't think that my delivery on that whole thing was great, but I think I got the point across, yeah.
Point hike in July.
On the reinvestment,
You can tell some of these journalists are not enjoying their loss of purchasing power, says News Squawk.
and for the APP, both of them will now be operative as of the 1st of July for APP and has already begun for PEP. It is a matter that we will be discussing within the Governing Council, which we have decided not to debate today. We had, as I said, plenty to do already in the last couple of days, but we will be looking at it. And I have to tell you something. There are some of us on the Governing Council who will be interested not only to debate
UBS upgrades Tesla stock to buy as Chinese shutdowns may hinder the production output of many EV competitors, says Yahoo Finance.
morality, but some of us are also interested in looking at how
So there's some interesting back and forth going here in the ECB, but I don't know. I'm not as so interested in it.
I said already before that a green,
So far, not hearing anything too significant, though.
I think the reinvestment decisions that we will make in the coming months and years might also be inspired by this concern that we have. Okay? So that's point number one.
Yeah.
Your point number two is, why not 15 July? Well, we are coming out of 11 years of no interest rate move. We are on our path to exit negative interest rates soon. It is good practice, and it is actually often done by most central banks around the world.
Yeah.
With an incremental increase.
I mean, so far it sounds like that what's coming out is like largely in line with expectations, and the treasuries are moving down just because it is like hawkish move. But I don't sound like there was anything too far out of line with expectations. Let's come over to Zero Hedge and just see if there was like something in their original statement that I missed.
Target in the medium term. We also want to observe how markets are going to operate. And as I have mentioned, we couple our July determination with our September indication.
Jobless claims. Oh, I didn't even think about the jobless claims. What was they?
Martin Arnold, I think you raised your hand of the Financial Times.
229 versus an expected 207, so not too much, but 200 is on the higher end of things.
Could I ask, first of all, is this today a signal that you are dropping gradual normalization in preference for...
Yes, I don't see anything big here.
Undesirably elevated inflation?
So what usually happens is they try and cut things off when the S&P 500 starts, and then they trade it. So then we really get to sort out what happens. But
would those only be designed and launched once the existing instruments, i.e. PEP reinvestments, have been fully utilized? Thank you.
President Mario Draghi spoke out beforehand to say there's still spare capacity in Europe's economy.
The monetary policy statement.
I think that the euro is kind of in a tough spot because if with everybody else raising, if they didn't, wouldn't be very good for the currency, right?
Which we will proceed are captured on the top of page.
They're not crazy like Japan. They couldn't get away with the sort of thing that Japan's doing right now, right?
We'll maintain optionality, data dependency, gradualism, and flexibility in the conduct of monetary policy. So, all four will matter, and there will be circumstances when one might be more important than another. And there might be other circumstances where the pecking order will change. So I think by doing that, we are trying to have as much optionality as we can, be able to use flexibility if and when warranted and necessary.
It's kind of funny. You guys had like a bunch of questions, and now I'm like kind of like, ooh, I said a lot. Let's rest for a little bit.
Deploy the
but now I've like rested too much. I'm almost like starting to get into it. Maybe I just go to sleep.
And I think in times of great uncertainty, gradually,
Prime Minister Fumio Kishida appears to be counting on the Bank of Japan to keep our own costs near rock bottom lows as his government paves the way for continued spending even after a record-breaking splurge during the pandemic. Yeah, I can't.
Come back to this issue of fragmentation because
The Japanese yen is taking a hammering, right? That's all I can say about it. I don't know. There's this thing I've been noticing though, like so you remember this story we talked about earlier in the week where Janet Yellen in her biography basically said that she did not like the administration's economic plan, but she didn't speak up or say anything. So if she didn't like it, it was only privately, but publicly it was always, you've got to stay in line with what the administration says, right? Well, I say this is kind of like a little bit like have balls. But I think that the problem is that she's the Treasury Secretary, right? So I think it's the Treasury Secretary's place to say to Biden, like, no, that's a dumb idea. We're not going to do that. And to be a thorn in their side until everybody can come to an agreement. You don't want to have like a public. Obviously, it's a very bad politically if you're having like an outright fight with your top economic advisor, right? But I don't know. You should work that out. But I think that Janet Yellen is correct in the larger scheme of things, particularly if you're the central bank, which is to say, you as the central bank do not want to take a position that pits you directly against the administration, because that's gonna really undermine confidence, right?
Come back a little bit on why do you
around that time, Kyle, was when the ECB interest rate announcement was.
Well, thank you for your question.
Okay. You agreed with the Fed all along the way, and that's not 100% accurate.
That we have analyzed is attributable.
I was through all of 2021 saying that inflation is going to be higher than they expected, right?
Exogenous bottlenecks that is clearly.
I remember saying on many occasions that they have a good argument on that there are these transitory factors, but there seems to be some other factors that aren't so transitory, and I don't think it's going to go away as quickly as they think.
Inflation
right.
being above 2%.
What firm did you work at? I worked for Goldman. But I didn't trade for them or anything. It was nothing knew anything. It's interesting. I was in technology. It wasn't even a quant. It would be nice to go back and be in the quant world, but man, you got to learn a lot. You got to learn a lot to get into the quant world.
And potential spiraling. We are not seeing.
But no, like but let's go back and kind of game that out, NASDAQ killer. What if we go back to 2021, Federal Reserve does extra stimulus or whatever the deal is, right? And then hold on, I need water here.
Wage increase. We're also aware that Germany, for instance, will implement the minimum wage as of October 1st.
Okay, so Biden administration comes in, they implement all of this stimulus, and then let's suppose that Jerome Powell comes out and says, well, this is a bad economic policy and it's going to cause inflation, and so we as the Federal Reserve need to preemptively start raising rates in order to fight the coming inflation that Biden is going to create. Okay. What if he had done that? Think about that, how big of a problem that would have been. Because what could happen then is you slow down the economy, if not create a recession. And who's going to get the blame for it? The Federal Reserve is going to get the blame for it, right? The administration is going to say, well, we were stimulating the economy. Like, we were doing what we were supposed to. The reason that things fell was because the Federal Reserve was dumb, right? And having the Federal Reserve and the administration at odds, basically the Federal Reserve trading directly against the administration, that's not going to be a good thing for the economy. That's not going to inspire confidence, right? So you don't want to do that. What you do instead is you just kind of toe the line as much as you have to. And then when things don't work out, who takes the fall? The politician does. So in the end, they did the right thing. The policy mistake that Federal Reserve made was holding off on normalizing interest rates because of Omicron. They should have been well ahead of that to say, well, Delta didn't really have that big of an impact. Omicron, the risks are that further inflation, and we should start normalizing things now, rather than waiting to make sure that further waves don't create another pandemic, panic, whatever, blah, 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 right? That's where I think that they made the mistake. I understand why they would take the cautious approach and everything, and I understand that we have the benefit of hindsight, but I think that at the time they had enough information to be able to make the call that it wasn't a significant thing anymore, right? That's the mistake that they made.
Thank you very much for
and really, when you put it in that context, right, the mistake that they made really isn't all that big, right? Because everybody seems to expect perfection from their Federal Reserve Bank, and that's not possible.
Not just the DFR. For future references, as of
What's the form you worked out? I don't understand what you mean by that. Didn't work with any forms.
And I think
the systems that I worked with were the systems that sent the orders to the exchanges, essentially.
Return to a better symmetry.
They would take orders from hedge funds, clients and stuff, and then they would forward them onto the exchange. That's what we did.
On the conditions that would.
How long? Oh, it was about 6 years. Which apparently for them is a long time.
Let's be clear.
Most people don't last there that long.
The critical point is monetary policy transmission, and we are very
stressful. They ask a lot from you.
Throughout the entire euro area, so there is no specific level of yields increase or lending rates. Or
kind of curious to me that there's kind of a steady trickle of volume in the treasuries today. You can see there's a few robot machine guns trading here and stuff.
Fragmentation that would impair monetary policy transmission. And we will determine on the basis of circumstances, of countries, how and when.
It might be just that like my body is kind of wanting to fall asleep, but like I feel like really heavy and shortness of breath and stuff. It's just like it like that when I'm tired. I really hate that feeling.
WebEx and take a question from a colleague in
And that makes me want to not speak as much and breathe more.
So Andres Stumpf of Expansion, your question please, and please turn on your camera and your mic.
Are Euros still flopping? Yeah, well, I mean, ECB speaking.
Andres, for the time being, we can.
I really don't like trading as a retail trader during these press conferences unless they really say something that is groundbreaking. You're getting old. I am getting old, dude. Like you see here on my beard. I mean, I can't really tell. I don't know if you guys will be able to see it through the stream with the codecs and everything, but like there's some gray on my chin, I think. At first I thought it was like, oh, those are just the blonde hairs, but no, I think it's gray. It's like straight up gray now. So I am getting old.
Thank you very much for your question. I can only repeat what I have said, which is that we will not...
A few little gray hairs.
Fragmentation that would impair...
I mean, I am 37, so...
...policy throughout the entire euro area.
Almost to over the hill, right?
That is embedded in the reinvestment...
Which is so funny because I don't feel like I'm that old.
We'll demonstrate, if necessary in the future, that we can design, we can deploy the appropriate instruments to prevent.
It's weird to go back and think about things like things that I could have done differently and stuff. Definitely could have done some things differently that would have been more in line with my current goals. And the problem is just that like my current goals were not my goals at the time. So,
good afternoon. And thank you for taking questions. President Lagarde, I have two questions. One is on the importance of data dependency. And looking beyond September for rate hikes, the Governing Council will adjust the monetary policy and it will depend on incoming data. Can we expect then lift-offs to come on a quarterly basis, coupled with the macroeconomic projections? And my second question is on financial stability, because you mentioned it. You mentioned that banks...
I really hate when you've got like a range and the treasuries are able to sweep across the whole range back and forth over and over again.
Financial stability in a war situation. Thank you.
I have to tell you that I'm concerned about the war, full stop, but your question goes further than that, of course, and the financial stability side of the question, I will defer to my...
that Euro accent is a turn on.
Vice President de Guindos.
I have to say, as a person, I really quite enjoy Christine Lagarde's press conferences, right? I have some concerns with how she will handle individual questions that kind of sometimes makes me think how well she personally understands this stuff. She's not as good. Like Jerome Powell. Jerome Powell is not like a speaker, okay? I think that he's grown into the role and that he's getting better at it. But in the end, you can tell that Jerome Powell is a wonk, right? He would rather be sitting in his office messing with spreadsheets than he would being out in front of the press. Whereas with Christine Lagarde, this is her. She loves it doing this. She quite enjoys it, I think, right? She's a people person, and I think that as a person, she's quite affable.
In December, and we have done it now in June. And here, the message is quite clear. The vulnerabilities of the financial system.
I don't know. Like one of the issues that I always run into with the ECB press conference is that I just don't understand the political structure and the context of what people are thinking in the Eurozone, as well as I do in U.S. politics. And so, a lot of it is just like,
the conclusion that we have reached that is in
I feel like most of the press conference is a waste of time. But I know that that's not actually the case because for the people that are over there, should the things that they say kind of impacts their view of things, even if it's not new information, right? Just like it happens in the U.S. press conference.
This is the main conclusion. And, we try to make an assessment that covers not only the short term, but as well the medium term.
Thank you very much, Vice President. That brings our press conference today to a conclusion. Thank you for coming here.
I would just like to add something, because we are here standing in Amsterdam.
She would like to add something, huh?
Is with us, and for those of you interested, we had just a fantastic meeting that was organized under the auspices of the De Nederlandisch Bank, under the leadership of Klaus, and it's been just a really good, fruitful and productive experience. Geography matters, and hospitality can help a great deal. So thank you to the Netherlands, and thank you to the National Central Bank of the Netherlands.
They themselves don't. I don't think that that's accurate.
Is on 21st of July in Frankfurt. Thank you, and have a good afternoon.
Like the whole thing is, I don't think that Christine Lagarde has the vast economic knowledge that is typically expected of a central bank president. I don't think so. But it's not like she's clueless on economics, and she's got a whole team behind her. Right. She's not as much of a wonk as Janet Yellen was, or as Jerome Powell was, right? Like, I think that a lot of people would be tempted to come in and say, oh, well, you're only saying that because she's a woman. No. Like, listen, Janet Yellen knew her shit. Okay. Like, that's why this whole thing with Janet Yellen, can we trade now? Yeah, probably. Looks like we're getting a decent recovery there coming into the end of that ECB press conference. I'm kind of wondering if they're going to go and try and make a move up to 0.2. She was with the International Monetary Fund before that. Yeah. But, and you know, when Janet Yellen spoke, like, I think that the best example is just go and watch the last press conference that Janet Yellen did. Because in that press conference, you know, she was not, they were not as concerned about like assessing what the economic state of things was, because nothing was really happening. They weren't really doing anything right. And so they spent a lot more time like, okay, let's see what kinds of granules of economic wisdom we can get out of Janet Yellen. And so there were several points during that press conference where she really went into some detail about economics relating to interest rates. In particular, talking about why the yield curve is so flat, and that the current economic conditions are as such that the yield curve is more likely to invert than a normal economic cycle, right? Was very, very, very good information, right? Like, she totally understood the market, right? And that's why this whole episode with Janet Yellen as Treasury Secretary has been so frustrating, because you have a person that is there in office that very clearly understands what they're doing and is really good at what they do, but basically the administration did not utilize that at all. They basically ignored what her recommendations were, right? They ignored what her recommendations were. And then instead of her having a backbone, she went out on television and, you know, supported their nonsense when she knew better, right? And really kind of like undermined her own credibility. Like, I get that you don't want to come in and have like a spat with the president or you're the Treasury Secretary and all of that sort of a thing, but don't get up on television and tell us things that you know aren't true, right? Don't be a stooge. Have some self-respect. You go and you tell them, listen, I don't think that this stimulus is necessary or good for the economy, and it will result in some inflation. And if you want somebody to go on television and try to assure everybody that it won't, you're going to have to go find somebody else, because I'm not going to do that, right? Find another Treasury Secretary if you really want, right? That's what I would do. That's what I think that she should have done. So have a little backbone, right? You're not gonna like publicly undermine them, no, but have some backbone. That's why it's frustrating, right? But like this is the thing that's so interesting about it is that Christine Lagarde is more the people person, and I think that she's a good leader, and so I think that you kind of get those attributes, and those are valuable too. There's some good things about that too. So I don't know. A lot of traders hated her during her mandate. Janet Yellen? I don't know about that. Like, of course, there's always somebody that hates, certain individuals that are in power, let's say. But I would bet that if there was polling on this fact, that Janet Yellen would probably have the highest favorability rating while she was in the position of any central bank president in our lifetime. Perhaps even more so than Ben Bernanke. She just kept everything easy the whole time, and there was no real controversy. I think she should have raised interest rates a little bit earlier, but hey, worked out okay, I guess. Look at that, all the way back up to 02, so quick. I'm actually a little surprised how fast that went. Little surprised how fast that went there with the treasuries. Is Michael Higgins Janet's brother? I don't know who you're talking about. Yeah. I don't know. Being the Federal Reserve president, the thing is as popular as she was at the time, is really quite a feat, because with the Federal Reserve, you're always in a rock and hard place, right? There's always going to be a large group of people that both benefit and are harmed by whatever interest rate policy you set, right? That's just the reality of it. And there are going to be situations where the Federal Reserve needs to take actions that are not favorable for a lot of people, but have to be done because the alternative is worse. Like sitting down and doing nothing would ultimately be worse for people. This is what was pissing me off yesterday, man. So there was this creator on TikTok talking about the Federal Reserve. And this person is like, she doesn't outright say it most of the time, but she is a far left modern monetary theory wacko, cuckoo, whatever you want to say. There's one of these people that, they walk around and they have the I don't want to say name recognition. I don't know how popular she is on TikTok, but basically because she's pushing modern monetary theory, there's a group of people with a political axe to grind that are going to promote her, right? Even though it's a kid that's been out of school like 2 years, something like that. And her whole video was basically like, the Federal Reserve, I can't even remember her name. I think it was like Katie Burbank or something like that. Listen, you go on my TikTok and the video's there, and you can see the video that I stitched, okay? So I can just give you my opinion. My opinion is that she's a modern monetary theory promoter that doesn't actively say that, but basically everything that she's pushing is modern monetary theory. And in this particular video, she basically like gave it all away and like said what she really thinks. And what she really thinks is that the Federal Reserve doesn't need to raise interest rates and that they're only doing it to keep people poor. Is basically what she said. like she literally says in the video, so the Federal Reserve is just trying to keep everybody poor? It's such a dishonest thing to say. It's such a dishonest thing to say, guys. Like, okay, the Federal Reserve job is to keep price stability and maximum employment, okay? Those are the two things that they kind of have to balance, okay? And it's not about keeping people poor. It's that price stability is the most important thing for you economically. If the Federal Reserve didn't come in and do what it had to do and raise interest rates and just let inflation go out of control, that would be more harmful to all of us economically than what we're experiencing right now with the raising interest rates. So to say that it's just all about keeping people poor is just such it makes me mad. It's just such a dishonest, harmful, it's really harmful to people's understanding of the economy to be saying things like that, right? And that's all because of this modern monetary theory nonsense. How did I even get on that? I don't know now. I was saying that's the thing that make me mad. Oh, because so like the thing is the alternative is worse, guys. Like that's the problem, is that the Federal Reserve isn't always going to make the perfect decision every time. Okay, it's you can't expect perfection from your central bank. You just can't. Okay, and a lot of people would say, oh well, they're always wrong. They're absolutely terrible at what they do. Why should we trust them? Yeah, no. Like the thing is that if they're even right half the time, that's really good. Okay, like you have to really put into context the difficulty of the thing that we're trying to do here, and like that's the crazy thing about it, is that with as difficult to, if not impossible, of a goal of what they're trying to do, the Federal Reserve in general has actually done quite a good job, and the world is better and more economically stable with the Federal Reserve than it was before the Federal Reserve, right? And I know that a lot of people don't want to believe that, because it's easier to blame the Federal Reserve for whatever situation you have things right now. But you just got to remember, they have a mandate. They're going to go and do what is in line with their mandate. Okay. Anyways, NASDAQ trader was correct in earlier, which is that, like, I didn't agree with everything that the Federal Reserve was doing. I do think that they should have started raising interest rates earlier. It's always kind of like they're always a little bit late, right? But I very much support the Federal Reserve as an institution. I don't think that they always get it right. I disagree with them, but I 100% support the Federal Reserve as an institution. I think that all these people that think that we should abolish the Federal Reserve are crazy and have no clue what they're talking about. You mentioned a book earlier that teaches about the DOM. What's it called? It doesn't teach about the DOM, Dante. It teaches about it's basically a quantitative finance book about market microstructure. So the video that I'm talking about is the stylized behavior of markets. And the book that I'm talking about is Trades, Quotes, and Prices, Financial Markets Under the Microscope by Jean-Philippe Bouchot and a bunch of other guys. What's the other people? Bonnart, Danier, and Gold. These are all like huge, big names in the quantitative finance space. So if you go to archive.org, Jean-Philippe Bouchot is the lead editor of the quantitative finance section of Archive, right? And so, and that book is essentially like a summary of everything that we know empirically about the market microstructure, right? So they go through, how a limit order book works and all of that sort of thing, sure. But what they're doing in that book is they're setting up mathematical models to try and explain why the book behaves the way that it does, right? So the big my favorite, let's put it that way. My favorite such property is the square root law of meta order impact, which is basically if you are a big trader and you're going to come in and you're going to trade a large meta order of like 1,000 contracts here in the treasury or something like that, what is the impact that it's going to have on the market? And it tends to follow a square root law. Which is kind of interesting because it means that 1% of the volume can be responsible for 10% of the volatility. It means that orders have a much larger impact on the market than people want to believe, right? That's the sort of stuff that they talk about in that book. And it is useful as interpreting the DOM. I'll give you an example. One of the things that they show is that, if you have a queue here, there's a certain number, like constant number of people that are adding, jumping into the queue. And there's a constant number of people canceling, getting out of the queue. But another thing that happens is that the more people there are in the queue, the more opportunities there are for people to cancel. And so what that leads to is there are certain numbers that they will kind of converge upon unless something changes. And that's why when you come in here, you'll tend to see this thing like they'll bid 500 to 700 contracts, and that's maybe stable. And then from there, it'll jump up to like 1,100, right? And you'll see that over and over again that like the DOM tends to like certain numbers. There's a mathematical reason why that is, right? And they talk about that in the book. It's a big book. Well, I mean, it's not a huge book, but so I have it over there, but I don't want to go and grab it. Okay, it's highly mathematical, right? Like it's graduate level stuff. It's difficult reading. You probably want to have a pen and paper, take notes when you're doing it, and maybe read it twice. Like, I kind of summarize the key points of it, right? But it's not about DOM reading, right? What I'm kind of saying is that you can if you know these things that are like empirically proven about the DOM, and that can really kind of inform your own, like, trying to get a read on this sort of a thing. Yeah, I just link it to you guys on Amazon, right? Oops. Here it is. Here's the book. That was interesting that we were starting to have another little bit of a move up, and then they fell back hard. Trying long on an RTY. I'm not quite sure what to make of this market so far. Treasuries look bid. S&P 500 is down. I'm not so sure if those trends are really going to continue. Like, I'm not sitting here saying, oh yeah, the treasuries now, they're going to try and go all the way back up to like 118.09 or something. No, I'm just kind of like, meh. They're still just kind of floating around. They're still just kind of floating around, so I don't know. I think that there could still be some movement, but I'm wondering if they kind of, it's the theory behind, well, no, like price action is something totally different. Listen, as far as I'm concerned, price action is nonsense. I don't think that there's, none of the things that I've ever heard about price action has any kind of empirical backing. But it is everything that we know, and very often, and pretty much in every instance, they're able to show like why it behaves that way. What is it about the way that the market is set up that causes it to behave that way? Because it really has to do with the mathematics of a limit order book is what's interesting about it, right? And it's a really useful piece. But I'd have to say I wouldn't put it down as like required reading for retail traders. If you were going to be like a block trader for a bank, then it's required readings. Right. So maybe it should be a required reading for a trader, just because if you want to be the best, then probably you do want to understand everything in that book, huh? I guess I'm just trying to give you fair warning. Like, it's heavy math. It's not an easy book. It's not anything like what you've probably read for trading books in the past, okay? It's real, like, research-backed mathematical information about the market. That is, it just makes everything else that you've read about day trading, all these books where they talk about moving averages and price actions, setups, and all that sort of a thing. And then you go into this thing and they say, okay, here is how the market is actually set up. Here's a mathematical model that's trying to emulate that particular property. And here's the results that we get from that mathematical model. And here are the actual results from the market that support our mathematical model, right? It's real shit. Okay. And it just makes everything else look like trash in comparison. Why do you like the treasuries? So the reason I like the treasuries is, one, because they're the most liquid market. There's a lot of orders, and the more order flow and liquidity that you have, the more likely it is that you will be able to find a consistent alpha. And that is because you're going to have these large institutions coming in and regularly doing things that you can potentially predict. It's kind of hard to just look at the market, market price and patterns in price and sort those sorts of things out. But if you understand how those institutions work, you can kind of look for them and you can find them. Okay. And the other reason is because, again, the market is more statistically efficient than it is informationally efficient. So we want to look for places where we can find that informational asymmetry. And it might not even be like that your opponents don't know these things, but like they may be not concerned with them, or they can't act on them because they're hedging or whatever the deal is, right? And I think that treasuries is kind of the place where there's a good balance between your ability to be able to develop that kind of informational edge and actually have access to the information, right? Like, I could go and trade copper, for instance, right? But I'm not privy to all of the things about like how a copper mine works and what are the factors that affect how much copper those copper mines are actually making, and what are the factors that affect how much demand there is out there for copper. I think I kind of want to have more exposure to copper long term, but trading it on an intraday basis, I'm not that guy. You could become that guy. You could become that guy for sure. But I don't know what all that is, right? Where with the treasuries, that kind of information is a little bit more accessible and easier to find. And so I think that there's kind of that best balance. And so that's kind of why I stick to the treasury. You put the name in that, yeah, sure. Okay, so to the question, do they have skin in the game? Yes, they do. So Jean-Philippe Beauchot is the co-founder of what is it called? The Capital Fund Management, the most generic hedge fund name ever. But essentially, they're a firm that has multiple funds, and they are some of the best performing funds of their kind. Like they won a award for best 5-year risk-adjusted returns with their Discus strategy over there. Okay, so yeah, well, what you will often find is these people that are working for universities and are like at the top of their game for universities are also working for some of the top funds and banks and so forth. So yeah, these like when if you start researching these people, right? Like what I did was I read the book and I was like, wow, this is really good. I want to know who these people are and I want to get more involved in that world. And once I started to do that, and I did more research about these people, found them on LinkedIn and stuff like that, it was really like, how the hell do we not know these people? Because these are really the leaders of our space. Like in terms of like the like CTA strategy type of thing that would be like discretionary and how much money can you make, right? The people that are doing the best with that right now, that's these guys. That's some of these guys. I mean, Renaissance is probably the best, right? But these guys are up there. These guys are up there, and it's like retail traders. We don't talk about those people. Who do we talk about in retail trading? We talk about the people that supposedly had success as a retail trader in the past, or or selling a platform to us, right? It's really kind of if they had success in the past, this doesn't necessarily mean that they're going to have success, that following them is going to derive success for you in the future. In fact, there's very much the case that if people have had success in the past, that they're an outlier and that following their methods is not likely to lead to success, right? The more likely that their success was based on luck, right? Whereas you're following these guys that I'm talking about. Okay, these are guys that they have information about the market that's proven, so it has absolutely nothing to do with like how much money they've made, although they have made money from it. Okay, they are at the top of their game, but that's not the reason why you follow it. The reason you follow it is because it's like empirically backed information that's proven about the markets and is really quite elucidating about why the market moves the way that it does, and just absolutely smashes through all manner of myths and misconceptions that retail traders have about the way that markets move, right? Look for experts, not gurus, right? Guru, their authority is based on their past success. An expert's authority is based on a command of the facts. They can sit down, they can show you the data, they can prove that this is a thing, like because they've done the research and they've proven that this is a thing, right? They're not relying on their own, they never even talk about their own success because it's not pertinent, okay? You don't come into a peer-reviewed research study and start your paragraph out, I made X amount of money and I am the smartest person in this particular market about trading this X thing. And this is what I believe about the way that the markets would know. Nobody would approve that peer-reviewed study. Heck no. Right? What is a peer-reviewed study? Here is the data, and here is how the data supports our conclusion. And we've had a bunch of other people look at this and verify it for themselves as well, that this is a true thing. And then we publish it in a paper, right? That's an expert, right? And I don't like to come in and be like, follow X, Y, Z people on LinkedIn, because I don't think that they want to be harassed by a horde of retail traders. Okay. They have their own jobs. They can't really say too much to us about what they're doing, right? Because they work for big funds, right? They work for big funds. But look for experts, not gurus, and find them on LinkedIn, because most of them aren't allowed to post on Twitter. Yeah. Oh, hold on a second. My mom's calling me. Okay, so then next question is, can I use that information to increase my edge and increase my income by trading. Maybe. I mean, that's up to you, right? I believe that any piece of information about the market that you can prove using data could be a source of potential edge. I think one of the keys here is that this is kind of like the basis for which a lot of firms use to trade. Okay. So these kind of empirical properties about order books has kind of informed the way that block traders at the large institutions like to trade, right? They know that they're going to have an impact on the market. So what they do is they move the market until it creates this liquidity hole, and then they're able to execute a lot of orders within that liquidity hole, right? And once you understand that, can you as a retail trader kind of understand what's going on and see that and try and take advantage of it? Absolutely. Absolutely. It totally helps. I think the thing that helps me the most that I got out of that book was the timing of it. Because what I always found would happen to me is like we'd get a leg and it would move up. And then I would get in at the top of that leg, right? And it'd come back and I'd get disappointed, I'd get out, and then it'd go further. Okay, so here you get in this pattern, I forget what they call it. It's like a bull flag or whatever, right? Right? Okay, of course, you want to play it like that. You want to play a bull flag. You want to get in right here, right? Okay. Well, so then I would come in and I would say, okay, we're getting a bull flag. It's come down a little bit. This looks like the price. I'm going to get in now. And then what would happen is it would go a little bit further, or it would sit here, it'd go up, and then it would just go nowhere, and I'd get bored of it. And it's like, well, it's been too long. I don't think that it's going to get out, right? Well, once we understand the empirical properties of the order book, we understand that there is a decay function that decays with a 3/4. So the impact is a square root law. The decay function is the 3/4 law, right? And so you can use the timing of this to predict what the timing of this is going to be. It's going to be longer. It's a 3/5 law, right? So you take this time and times it by 1.5, and that's about how long it should take for the function to decay, right? But generally speaking, in the treasury market, it's about 45 minutes. So that has helped me time my trades so much better, right? Is like I don't get in this trade and have to sit for like 30 minutes and wait for it to happen. Instead, I can come in and I can say, okay, well, we missed that first move. Wait 45 minutes for the next move. Oh my gosh, that made such a difference. It's like a really, really simple heuristic. I'm really simplifying things, but can you see how we were able to take information that we learned from this empirical study and kind of simplify it down and turn it into something that helps you trade, right? So how you use it, up to you. But they're putting that information out. I think the reality is that that's like the base. What they're saying is, this is the base. If you want to do what we do, you've got to know all of these things first, because everything that we do where we work is basically based off of that. It's based on extending that framework. 45 minutes, regardless of current volatility. Well, as I say, on average, it's about 45 minutes. But the more accurate way to look at it would be to measure how long it took for how long the initial meta order was. Assuming that you were getting like a clear meta order of sorts. Because there will be those days where like the treasury just trends and trends and trends, and there's never any real pullback to speak of, right? Yeah, I mean, I don't want to say they don't come into that book. Let me be clear. They don't go into that book and say, wait 45 minutes. They don't say that, right? That's just kind of my application of it. But what they do in the book is they say there's a time decay function, and here's the mathematical properties of the time decay function. It follows the 3/5 law. Super interesting, though. I don't know. It's kind of hard because, like, I think it's hard to truly understand it all without going into the math of it, right? Once you go into the math of it, though, I think it's just like mind blown, right? That was really when I got to the point, especially chapter 10? Informational content of prices. That chapter was the one that I was truly like absolutely absorbed, and I read it like 2 or 3 times, and I was like, oh. Because like I always intuitively understood it. I was always kind of teaching that principle here on the channel. But when they actually went through the math and how they came to that conclusion, it really truly made it clear like how I should present it and what the reality of it is, right? Market is more statistically efficient than it is informationally efficient. And why is that? What is it about the market that makes that so? It's because orders have such a strong effect on prices. So it only takes a few retail traders trading together to remove a statistical inefficiency from the market. And meanwhile, a random trade from some big fund that has absolutely zero informational content in it whatsoever will move price completely away from where it should be. So you can't be informationally efficient, but it's statistically efficient. And that's what makes trading the market so insanely difficult, because we're all coming out there looking for some pattern that we can find that's consistent in it. And anytime that you find a pattern, trading it removes the pattern. But the informational inefficiencies are always there. So if you can find a situation where something changes and you know that the orders that are going to come in are going to be in line with this informational inefficiency, then that's when you can get really good trades, right? We're talking about trades, quotes, and prices, financial markets under the microscope. This is my favorite book. I have to say, my view on things changed. Like I said, it wasn't like I didn't understand some of these things intuitively to some extent, but like once you understand the math about it, it makes it so much more clear, and it makes you so much more confident about the things that you do know, and so much more skeptical about the things that we don't really know, that everybody seems to think that they know, but they really don't, you know? I can come in and I can be really confident that it's like, okay, well, there's a middle order here and there's a middle order this way, and this is why, you know, here are the things that matter in this situation. It makes such a difference. It's a really advanced book, though, I have to say. We were saying, look at the dumb, fuck the experts. Well, so like there's this other intuitive thing about the way that the order book works, right? Here's the thing that I think is interesting about trading is that there's like really, if you're trading, I'm not sure what you're talking about, Hydro, so that's why I didn't read I thought find a way to provide liquidity to day traders and you have an edge right there. Oh, we could talk about that in a second. I think you're hinting at a certain thing, and I think that a lot of people actually, let's talk about that. So one of the things that we say frequently is like, you know, the market maker is always out there to screw you over, right? And I think that this is most commonly seen in discussions around like ranges, right? Is like, if we're in a range, you want to have like a clearly defined range, and then you want that range to be broken so that everybody comes in and buys the breakout, and then you smash it back down, right? Oh my gosh, I don't know what happened with my display there. Everything kind of screwing up, but I think that it was my pen here. Okay. And so the market maker makes this happen to screw everybody over. Well, you've got to keep in mind that there are limitations to what the market maker can do, okay? Because of the square root law of meta order impact and the inverse sign law, then the way that those two things work together. So if I come in and I buy a bunch of something, I'm going to have an impact that follows the square root law, right? So there's like kind of an optimal place at which they'll stop, and then they'll let it come down, and then they're going to have another leg, right? If that's not enough for them to trade at all, then they'll do it in multiple legs like that, right? But if somebody comes in, if they push the market that way, the market maker says, okay, I want the market to break out and then I want to sell it. So if they do that, okay, they break the market here at this point, all of these extra orders that are then going to get triggered, right, are going to come in at the place where the impact is low, right? So they're not going to get a whole lot out of those guys trying to follow them, right? And then if they immediately turn around and try and sell, because the liquidity is disrupted all through here, right? This is going to have more impact, generally speaking, okay? So if the market maker was trying to push the market up to try and trigger stops and stop you guys all out, and he was using market orders to do it, then on average, they're going to lose money. So that doesn't work, right? So here's what the market maker does instead. The market maker doesn't push it to a certain location. What the market maker does is they make it so that it's easier for it to go a certain way, right? They basically, we're in a range. If we're in a range, right, and we're right here, what they're going to do is they're going to pull all of their offers. They're going to make it so that it doesn't take very many orders to push through here. And then you get to the top, people start coming in. Now you're starting to get the meta order is in right here, right? So all of these guys come in. All of this right here is it pushing outside of the range. Okay. And then what are they doing? They're taking their fills out here now. Now they're putting the liquidity here, right? And they start pulling their bids so that it comes back the other way, right? They're making it easier for it to go a certain direction. Is that supposed difference significant enough? Oh yeah, absolutely. Because you're looking for something different, right? If I'm coming in here and I'm looking at the DOM and I'm seeing a lot of volume come through, and I'm seeing a lot of volume trading at all of these prices, like that's something that can run. That's like a real trend. That's a real meta order. Whereas if we're in a range and it starts moving quickly, but it's actually doing it on very little volume, like what you're seeing there is either one, there was a news event and you want to get out of the way, or the market makers are trying to let it float to a certain location. So then you don't want to mess with that one, right? You want to fade that one, frankly, because what they're going to do is they're going to pull the same stunt on you the other way. All of a sudden, they're going to pull their bids, and it's going to be able to move down on only a few hundred contracts at a time, right? That's how they play that game. They don't do it. They can't do it with market orders. They have to fool people into hitting into it with the market orders, right? So I think that very much changes what you want to look at, right? And it also kind of, I think, should give you a little bit of skepticism about especially what you see people in the cryptocurrency space say about, like when we don't go anywhere for a week, they're screwing with us, this sort of a thing, right? But when you're manipulating in cryptocurrencies, they got to do something more than that. They have to do like an ignition event, which is a little bit of a different thing. %, until they pull the bids and ask if TPs go too high or the presence of average order size is too high in either direction. Yeah. But it's the thing that's so tricky about it is that if we're having a strong trend in where the market is all in line and going in one direction, then you're going to see it move very easily up on very little volume. So you can't come in and say a trend with the low volume behind it is likely to reverse. You can't say that. But what you can say is if we're in a range bound market, or I'm expecting it to be range bound, that's how I can kind of tell where I want to reverse, right? The triggering event for a trend is that. And the other thing that you want to see, okay, is that there's your impact and here's the decay function, right? You want to hit it a little bit before the decay function finishes. Right there. So when you see a breakout, that kind of gives you a little bit of an idea of where you're looking for to try and fade it, right? You don't want to fade it here, right? You get stopped out if you start fading it here. You're not reading? No, I did read the... Oh, I did miss a comment by you. I know for a fact I won't be exposed for that long to the markets and the inherent risk that exposure comes from, so it wouldn't be useful. Well, but it could be, because what it is that what's going to happen is you're going to come in and you're going to say, oh, okay, I want to take a trade on the continuation of a trend. And then you're going to get in it, and it's not going to go anywhere for 10 minutes. And you're going to say, well, that's too long, and I'm going to get out, right? Whereas now that you know kind of when to time it. So you know when to wait. And could say come in next 45-minute period. There's always going to be so something that they do. So is that they will do multi-time series analysis. So basically what you do is you look at every time frame, 1 minute, 5 minute, 15 minute, 30 minute, 60 minute, hour, etc., etc., etc. And you're looking for all of these like patterns, right? And essentially what you're doing is you're trying to ensure or minimize the appearance of any kind of patterns on any of those charts, right? So what that means is that the point when the next leg is going to start is going to be roughly 45 minutes later, but there's kind of like a 20-30 minute window around that, right? So you can kind of guess when it's going to come, but not exactly, because they kind of randomize it a little bit to make it hard to pick up on, right? But now you can come in and you can say, oh, okay, I want to get in at 8:45 or whenever the last move was, and then I probably need to give it at least 20 minutes to see if it comes through. And then if it doesn't come through, maybe there's not actually going to be another leg, right? So it's useful. But that's just my take on it. Like the whole thing here is you should be able to take the proven behaviors that we know are a thing and be able to find your own strategy in which to try and take advantage of it, right? Like the whole thing here is let's get everybody up to that level where that's the sort of stuff that we're talking about. And then we can talk about, okay, let's design our own study to see if we can prove this other thing about the market that we believe is true. Or let's design our own strategy to try to take advantage of this, and how do we test and see that that actually works, and so on and so forth, right? That's what I say. Like, I think there's a real problem with what I'm doing, and that is that is still discretionary, right? It changes from day to day, so that makes it really difficult to prove that your strategy, your way of taking advantage of it works, other than you just trade it and I don't know, maybe you got lucky. But that was kind of what I was getting at earlier, is that any trade to some extent will always result or always requires a leap of faith. It's this really interesting contradictory thing about it all. Is we want to base our trades off of empirically proven stuff, right? Like if it's not like empirically, like why even bother? Why even bother, right? Well, but then if it was only known things, the market already knows all those things. How do you gain an edge, right? So to gain an edge to some extent requires a leap of faith a little bit. It's even if you have an empirically proven thing, it's still kind of a leap of faith that the exact way that you're trading it in the exact circumstances that you're trading it that it's going to work out, right? So it's kind of funny. It's the both things is you need empirical data, but you also need the ability to take a leap of faith too, right? But I have to say, like, can you read the DOM and make money from reading the DOM? Well, you got to remember that the reason that the DOM initially became popular was because all of these guys back in the 2000s were basically catching the edge and iceberging, right? They were coming in and they were just taking one tickers out of by saying, okay, when this bid is low enough, I'm going to hit into it and take one tick, or they stick an alligator in there, or they're trading a correlation. But they were basically arbitraging and scalping strategies, right? And sometime around between 2006 and 2008, that stopped working because the robots took it over. And that's when, like, Anthony Crudelli went from being the biggest trader on the CME electronic session to, pulling $1 million a year to, not doing nearly that, because, he lost a lot of it, and he said, oh, I should have understood what was happening, but I didn't, right? Okay. So now, since that time, then people say, well, is the DOM useless then? Right. This is the whole thing. Well, I wouldn't say that it's useless, because to really understand what's going on, to really see the orders, the DOM is the best way to do that, right? I mean, you could go and you could have one of these tapes that shows you all of the, every order that comes through. And those can be useful, but doesn't really give you the same sense of, okay, here's how many it took to clear this price, and here's how many it took to clear these price, right? Here's what's going on in the level 2. The DOM is just the most effective way to show it. So that's where I say the edge comes in the DOM, is that the DOM is the only way to truly see and understand what is really going on, okay? Now, does being able to truly see and understand what is going on effectively predict what is going to happen next? In my experience, no. In my experience, I've never found a situation where a particular market state or piece of market-generated information, patterns in price and volume, is effective at predicting what is going to happen in the future, except on extremely short timelines. There are some situations where the imbalance between the bid and the offer can be so extreme that it's extremely likely to do something. I don't like this. I don't like this thing that's going on here at 28.5, 29. There's some shenanigans going on there. I don't think I want to be involved in that. It looks like there's some offers trying to push the market down further to the bottom end of the range, but I would be concerned about that pulling or them busting through it and having a little bit of a breakout only for that to fizzle out and reverse on you, right? Maybe, or something of that nature. Like for that kind of a shenanigan, should we call it shenanigan? The heuristic that I'm using here, and this is not empirically backed, is that seeing unusual large orders later in the session is less likely to be a good signal that there's going to be some sort of a trend. Because why would they be placing those orders that late in the session? That's kind of more indicative of somebody that's in a position and doesn't want to be, or is trying to fool people. So I don't trade those. Anyways. I've never run into a situation where, except for on very short time frames, I've been able to prove that a certain price or volume pattern is highly indicative of a future move in price or future orders, let's say. It doesn't. Being able to understand the current market conditions, though, is an essential element, right? Because the market is not a black box. Okay, so what do I mean by black box? Market seems to be pretty stable. Yeah, like what I'm seeing, my take on today's action is the market has been really quiet all week because the ECB press conference and the CPI news tomorrow are pretty big risk events, and people don't seem to be all too interested in taking on risk until those two events come through, and then they'll make their decisions. So we just had the ECB press conference, and that created a decent amount of volatility. But in the end, there was nothing significant enough in there to justify any kind of long-term trend or trades based on that. Like, there wasn't really new information introduced into the market from that ECB press conference, from what I can tell. So we had a little bit of volatility, and now the market is just kind of, it's like a pendulum, right? You'd swing it one way, and then it kind of comes back a little bit and settles, right? That's this function, right? And then it settles. Big move, and then it kind of settles on a certain spot. Let's hope the worst of inflation is behind us. Yeah, that's, it could be the other thing. I suspect that the CPI comes in line with expectations, and that it's a real boon to the equities markets. I think that the term structure and the options kind of makes the S&P 500 prone to a bubble up kind of a move. And if they get a piece of good news on inflation, that could really give them a good push, beyond everybody's lines to make a further push up, but we'll see. So yeah, I don't really like the market trading here. What was I going to say now? I have to backtrack here. So I was saying past data does not predict future data except for on short time frames. And I was saying something else. It'll come to me here. Oh, okay. I was talking about the market is not a black box. Okay, so what is a black box? A black box is a function, and we don't know what the function is, but we can guess what it is. And you put information into the function, and it will spit something out. Okay. So when we do this in testing, right? I'll come in and I'll say, if I input, let's say that this function is, what is your name? Okay. If I put in my name as, drop semicolon, I can't spell today. Okay. If I put it in as is drop semicolon, I forget the exact syntax that you would want to use for this sort of a thing. Anyways, drop database, right? It should reject this because it's SQL injection. So the output that I should get is rejected, right? Okay. So this is what we do with black box testing in QA is I put in a specific input, and I'm expecting a specific output out, and I pass all in all these different inputs. And if this function works correctly, I will get all of these outputs. Okay. But the market is not a black box, right? Because I can come into the market and I can say the current price and volume, here's price and here's volume over, the last 20 minutes or whatever the deal is. I pass it into this black box, it will come out different every time. Okay, so what's with that? And we run into all this in QA, right? So then we have to come in and we have to say, okay, maybe there are other things that come into it that we're not accounting for, right? And oftentimes in QA, you can't account for those things, or they're not testable, and you kind of have to go around different ways about testing it, right? But here in the markets, what are one of the things that gets input? It's the future orders, right? Future orders. Okay. So really, when we're taking into account things, right, we don't just need what is the current price and volatility and history per se, right? What is also the future orders that are going to come in? That's another thing that you would really need to be able to do in here to be able to get out a consistent result from your function, right? But if we were to do that and we pass in the price, volume, and the future orders, there's still going to be this situation where you come in and you say, okay, this one time I bought 1,000 orders and it moved like this. But then this next time I bought 1,000 orders and it moved differently. And why is that? Well, and that is because this box has a state. So basically what has happened is what you passed into the box in past iterations is remembered by the box and affects how it will react to the next iteration of stuff that you pass into it. It is, in effect, it is a recursive function. So this output right here comes back into it and sets a state that is remembered by the box. Right? So that's why being able to watch the DOM is such a critical part of what we're doing, because what you're seeing on the DOM here is that state. What does the liquidity look like? Right? What does the volatility look like? How much shenanigans am I actually seeing in here, right? That's like the state of the box. And then you can come in and you can take the price and you can take all of the informational inefficiencies that we know to predict what the future orders are going to be. You can pass that into the box. And now all of a sudden you have a prediction that if you're doing everything right, if you're correct with all of your information, you should get a very accurate result about how it's going to move. Right? Because the thing that's cool about all this stuff that I was talking about, like the stylized behavior of markets, is that those edges don't come in and say, when you see XYZ, then you're going to see A, right? So trade long and you'll get this expected. So they don't say that at all, right? What they say is, if you input these orders into the market, it will do this, right? So it really makes sense for a big trader, right? Because for a big trader, it says exactly how you should execute, because here's the way that your execution is going to impact the market, right? So this is a big factor for them, right? But it doesn't predict those things, right? What is the truly predictive thing? The new orders. The new orders is the thing that you're trying to predict. Everything else that you're passing into the system is current information, right? It's not the predictive part. It's just understanding the current state of the market. But in order to understand the current state of the market, you have to be able to see all of the orders. You have to have been watching the orders and how, like, the last iterations of this played out. You also have to be following the news and be able to say, okay, like, here's the new piece of news, but like, here's what they thought before, so here's how they're going to react because of that, right? So there's all these things that you kind of have to take into account. So I think that a lot of people take the DOM, they come in and they say, well, what I should be doing with the DOM is I should be looking for a pattern in the DOM. Like, I think a really great example is here in the ZB. Well, we could do it over here too. If there's 2,000 is kind of like the largest offer and 2,000 is kind of the largest bid in here. And I can come in and say, well, but what if 29, instead of it only being 150, what if that was 2,000 and 29.5 was 2,000, and they were both pretty high liquidity there in the right? That's a pattern. Can we find that like 90% of the time it moves up and 90% of the time it moves down, and et cetera, et cetera? Well, on very short time frames, that kind of a thing might work. But my observation is that even if there is like a real statistical inefficiency there or variation, is usually not enough to like overcome the spread and like be a consistent moneymaker for you, right? You have to incorporate those informational inefficiencies. You have to predict the future orders, right? We need to understand the current state. That's why we need to use the DOM. But just trying to find like patterns in the DOM and trade off of those, and was never able to get it to work. Like just the straight up reality of it is like a statistically based, like purely technical, statistically based inefficiency that is consistently profitable over a 5-year time period. Never found it. Informational inefficiency. If I was always on the right side of, if I always understood the market correctly, that would be profitable over 5 years. Hasn't been for me because I make mistakes, but with the benefit of hindsight, you can come in and you can say, oh, okay, this is the thing that I misunderstood, right? And theoretically, you get to the point where you understand the market well enough that you can be profitable, right? But then it's all up to you. That's the other cool thing about this, is that I guess it's kind of the positive and the minus, right? Is that the minus is that you can be wrong, but the positive is that it's really all in your control. It's really all in your control, because it's all about how well you do is a direct function of how well you understand that market. Whereas if you're a technical trade, how well you're doing is literally just a function of that market. And there's nothing you can do about it other than choose not to trade it, right? I think you need to look for opportunities more than the same strategy over and over again. You need to understand market dynamics. There's no strategy. It's a hamster wheel. Well, yeah, but I mean, the whole thing that I'm kind of talking about is something that's going to change every day, right? So the factors that are going to predict future orders is different every day. And you're going to have to use your knowledge about the market to be able to factor out what those differences are going to be. Today we can come in and we can say, oh, okay, it is a ECB press conference. There's kind of volatility around that, but then it's not action you want to be involved in, right? Well, okay, that in that instance, it didn't give us a trade, but right, that's different from what it was yesterday because there was no press conference, right? People want to not have to do that. People want strict rules. They want, like, here's my 10 rules and here's the trade that I take. So probably not gonna make money that way. Any kind of strategy that was that simple that worked has been long arbitraged out of the market. Pretty sure, because I looked for a really long time, guys. There's a lot of really smart people out there that look for patterns like that, and I've never met one that found one that was really truly reliable over a 5-year time period. Think that looking for setups in the strategy that's going to work on that specific instrument is not possible? No. Well, but the thing is that there are patterns that you'll see happen over and over again, right? I think the one that you want to look for the most is the bull flag, essentially, right? Is and seeing these as multiple legs of a meta order. There's a reason, maybe there's a change, or maybe there is just they're rebalancing, but whatever the deal is, somebody needs to trade a large amount of contracts that day. They're going to do it in legs as they split the meta order up. Okay. That's a pattern that you can look for. Now, you can't come in and say, I see this, therefore I should take this. No. Okay. But it still kind of ends up being a setup, right? But the setup is based on a piece of information. I see something that I believe makes it going to trend all day, right? There's a piece of information that I think could make it trend all day. Like we were expecting a negative GDP or a negative jobs number, and it ended up being a positive jobs number. That's going to trend all day. Okay. I know that I'm going to see this pattern now, right? And so I can trade that pattern. In that respect, maybe it kind of ends up being a setup. There can definitely be like setups that you prefer. It's just get away from this idea that past patterns in price and volume predict future patterns in price and volume. They don't. At least there's no empirical evidence that we have that suggests that the case. And if there is such a thing, it's really effing complicated because we can't see it. We as humans, just looking at it, don't notice it. Right? It's the whole, I mean, to summarize all of this, technical analysis is faulty logic and doesn't work. That's really the bigger takeaway here, right? And takeaway number 2 is markets are really complicated. Trading's really hard. The challenge is being able to take all of that information that I just talked about and turning it into something simple that allows you to make decisions very quickly. Right. But that's where I think here again, like that getting a feel for the DOM and coming in and watching it every day, it just it trains your brain to just intuitively see it, even though you might not be conscious of it. So then when you combine all of that with the information that you're getting from the news squawk and everything, you just know the decision that you're going to make, and you do it almost without thinking about it. And that's how you turn it into something simple, is you practice it a lot. You train your brain a lot to do it, right? To the point where you don't even think about it. Like I could come in after the fact and I could say, here were all the factors that I was looking at that were going to predict order flow, et cetera, et cetera, et cetera. But in the moment, my brain literally summarized all that stuff and went in and made a decision within a split second, because it's doing that every day. I hope that answered all the questions about that. Right? And going back to Lucas's question about like, so do we know that a retail trader can effectively exploit it? That's where I was saying, well, there's kind of like a leap of faith involved here, right? You have to be able to like take the information that we know based off of this research and turn it into a strategy and hope that it applies in that situation. There's a little bit of a leap of faith, right? But what I'm trying to do is I'm trying to get you guys to that point, right? You understand all of that stuff, right? That's a base that you can then use to go and find other things, right? Because without that base, I think you're going to find it really hard to navigate finding an edge in the markets, because there's so much disinformation out there. There's so much that retail traders believe about the way that the markets behave that's really not true. So let's just start with this base that we know is true and start your research from there, right? You have this base, and now you can go out into the jungle, research, come back, make sure that what you've gone and you think you found out there is in line with what you already know, right? And not only that, but this base also gives you a really good pattern for you to be able to say, here's how you prove something empirically. Here's how they did it. Here's how you might be able to do it. This is like what's necessary to actually really like prove that sort of a thing. And do I have the ability to prove that or not? Et cetera, et cetera, et cetera, right? I hate central bank days euro. I'm actually, when I'm looking at this 6E, I'm not actually seeing a whole lot of significant movement. Maybe it's just because I'm like too zoomed in. Well, it did like the dollar did reverse pretty hard. It was like down at the beginning of the day and it reversed. They're going to raise too late for the market to like it for the euro, you think? Could be. I mean, this is why we talk about these, why we like to talk about these sorts of things though, right? Because how the market in general feels about the ECB's central bank policy and matters as to how they might react when a change in the market comes, right? How people feel about this, the ECB and more importantly, the Federal Reserve's current interest rate policy matters a lot to what they might do tomorrow if CPI is bad, right? Because people are kind of feel like that the Federal Reserve is behind the curve, right? So if that CPI number comes out and it is high, watch out. It could be ugly. It could be super ugly if they get a bad number tomorrow, right? You got to understand the state, and then you got to understand how the future orders will affect the market based on the current market state. Country that I'm leaving in has the most stable currency against the euro. Are you talking about the Swiss franc? I don't know. Let's see here. The Swiss franc took a big move up and now a big dive here this morning. Kind of curious, gold and silver looks like they kind of fell a little bit, even though the treasuries like recovered. So they're kind of not in line with each other. Tomorrow could be a good trade day. Yeah. I mean, I'm concerned that tomorrow is going to be there's a point at which the market becomes so volatile that it's not very favorable for retail traders, right? And tomorrow is probably going to be on the edge of that. So that doesn't mean don't trade it. That just means like don't go ham with it, right? If you get a really clear read, then go for it and make your money and then get out, because the longer that you're in it, it's probably going to mess. And tomorrow, well, okay, if the number is bad, we could probably come in and short the E-mini for most of the morning. I don't know if it's one that would be like a true trend day, but you could probably try and let it run. But you know, it's a situation where the volatility would be enough for you to like make a ton and then have it come all the way back to your entry and stop you out and then go and take off again, you know, that sort of a thing. I may just try and position my market in the night, hope it fades down, so I give myself a little more risk. Well, but so the issue on that one, Mr. Bond, the way that we got to think about it, again, here's current market state. What are the future orders? So what are the future orders going to be? It depends on whether the inflation number is good or bad. So we know that if the inflation number is bad, that is, it is higher than expected, that the S&P 500 is probably going to tank. And yields will probably blow out, right? But do we actually know that that number is going to be good or bad? We don't. If we're going off of the most recent data and the pieces of data that we've received since the last CPI that tends to be predictive towards the future CPI, I believe that the current market expectation is pretty close in line with what the estimates are, right? So I think the most likely scenario is that the numbers come out mostly in line and the S&P 500 rallies, actually. Right? S&P 500 rallies, actually, and an inline number, maybe you see treasuries puke, but it'll be kind of like a weird move that we don't trust, you know? You'd be like, I don't know if this is really a very good reason for the treasuries to move down, but do you believe in God? I do. Well, like I said, this is something that I think is so interesting about life, because I am 100%, and let's prove it empirically, person. My mind is, I think, largely because I'm on Adderall or whatever, you know, because of the medications that I take for my ADHD, makes you extremely logical. It kind of kills the emotional centers in your brain, right? You want to come in and say, like, this is the whole thing. This is what Star Trek is all about, right? Wouldn't it be better if humans were just perfectly logical? Because I think a lot of us, especially when we're talking about, like, does God exist? There's the people on the God does not exist side would probably say, you know, it'd be good if humans were perfectly logical. But the reality is that if humans were 100% perfectly logical, like, they would never be able to function. They would never be able to, like, make decisions, right? Like, there's the whole thing about, like, the robot's 3 laws, right? The robot's 3 laws and giving a robot purpose has to come in to play, because if the robot had to work completely off of just logic, pure logic, it wouldn't be able to make any decisions. It would always say, I shouldn't make a decision, right? It has to have a goal that it's working towards. It has to have something that it believes in and that it's working towards, even though there's no logical reason to believe that that's the thing that they should be doing, or that doing that thing is that they're going to be successful in doing that thing, right? So the reality of our existence is that we cannot function without some degree of faith. And that is true in trading as well, is that if if it's purely logic, probably the best decision is to not trade. If it's purely logic, probably the best decision in our current world is to not trade. It really is, right? In order to trade, it requires a little bit of faith on your part. We as humans cannot function without faith. So to me, do you believe in God? I don't have any kind of empirical proof to prove that God is real. And I want to base all my decisions off of empirical data, right? As much as I can, at least. But I understand that you have to have faith in something, right? Like, this is good for people to have faith in something. So why do I believe in God? Because it's good for me, right? That and that in and of itself, that believing in God is a good thing for you in the end, that's kind of a leap of faith in and of itself, isn't it? But that's how I work that out, right? That's where I'm able to find faith in things, right? Because it's a different, because I'm in Utah. We're Mormons. It's kind of a controversial thing too, right? But in the end, what I see is that the best decision for me is to believe in the thing, even though I have no reason to do so, right? Because that's the way that humans are. I think you'd be a good person if there's a God, you'd be fine. Oh, okay, I don't know what you mean by that, but we're getting deep into the philosophy again. Believe in being able to create a good future in life for yourself. Well, I mean, like, here's the thing: is like, what's the guiding principle, right? So to me, the purpose of life is to procreate and to make the world as good as possible for the next generation of people, right? That's why we do what we're doing here, right? Because again, like, when you hear me talk about trading and how hard it is, it really is like well, why are you wasting your time on trading, right? Why do I waste my time on trading? Especially if I have no expectation of actually making money from it, right? And two reasons. One, because doing this and streaming is really fun, and the act of trading is really fun, even if there's rough spots and I don't always do well, right? And I'm not really taking on a huge amount of risk, so trading is not a huge detriment to me, right? I love waking up early. I don't know what I would do with myself if I was sleeping in every day and not doing this stuff before. I would be bored, right? But I also understand that what we're doing here has led me to so much significant knowledge. I think that the fact that the market is more statistically efficient than it is informationally efficient, in particular, is a really huge revelation that a large portion of the Western world does not understand and is making bad decisions based on a misunderstanding of the true nature of markets, right? So I can very clearly see something where this is based on my knowledge and my temperament and my skill set, etc., that this, teaching you guys about this one thing, is the one thing that I can do that will have the greatest positive impact on the future for our future generations. And that's why we're doing it, right? It is for posterity. And meanwhile, I'm putting away as much money in retirement accounts as I can, so that, and trying to minimize my expenses as much as I can and be as healthy as I can, so that as much of that money will get passed on to my children as possible. Right? And everything that I've been doing, that we've been learning about the markets, helps me make better decisions on that. Help me make a better decision in finding a house, for instance. Getting a good interest rate on the house, because there's lots of people nowadays that want to be in houses and can't. But I was ahead of the curve because one because I was looking a lot longer than probably other people, but two, because I understood what the market was doing. And I knew that like, this is when I got to do it. I would have loved, I remember at the time being like, oh, I wish that we could save it. Cause I had it made, dude. I have to say, I feel like I had it made. After I left the firm, I got another job so quickly, was making so much more money than I was before. So I had this huge pile of money that I could have done anything that I wanted with. And on top of that, I was renting out all of the extra rooms in my house. So I was almost like living in this townhouse for free almost. It was only like $1,000 a month to live in this nice townhome at that point. And so I had like several $1,000s in extra income. And I traded it all for family. Is really what happened, right? I had it made, but I knew what I had to do to make things to give the next generation the best world possible, right? Because I knew about the market. So that's why we do what we're doing here. And I hope if you're here, like that's the why I keep going into this thing about like trading is hard. Is because like if you're here because your goal is I'm a greedy bastard and I want to make as much money as possible. You know what? I'm all about being a greedy bastard. Like if I was going to be portrayed as like a fictional character, I think it's Scrooge. I'm the person. When I watched that movie at the beginning and he's like, stop wasting coal in the fireplace and this sort of I'm with this guy. I'm like, I like this guy. He knows he's trying to be as efficient as possible. I like it. Right? Okay. I'm that kind of a person, right? But if that's you, don't trade. Because you're probably gonna lose money from it, right? You do it because you love the game. Yeah, there you go. You do it because you love the game. And what is the game? What is the purpose? You ever heard what is it? Simon Simiak? He says, some games are infinite games, and the goal of the infinite game is to keep playing. Right? That's what we're doing here. Because like somebody has to do it. Listen, if we don't exist, if retail traders don't exist, like this whole thing stops working. The whole thing stops working. Like what I think a lot of people would think, what we need to do to markets to make them fair to people, right? If we were actually able to get the market to the point that it was like that, where it was fair for everybody, the market would collapse. It wouldn't work anymore because there would not be enough noise for the informed traders or the market makers to work. They need that noise in order to facilitate transactions. Otherwise, it was just everybody knew everything all at once, then it would just be impossible to get anything done. The belief in God is anti-empirical. Well, I think it is anti. I was saying there, I have absolutely no empirical evidence that it exists, but I do have empirical evidence to suggest that a belief in God is good for you, right? Retail traders make the markets exist. ... Well, I know it's kind of a silly thing to say, but I'm just saying, if there wasn't all of these people involved in the markets, that are disadvantaged in some degree, market would not be able to function. Yep, our mission give the most accurate prices to the world. Yeah, I mean the whole thing is like we kind of have a goal here in trading that we kind of understand is kind of impossible to some degree, right? Crypto is like that, not enough. Yeah, probably true. There is just not enough liquidity in the crypto space right now that you just get this insane volatility that's really quite silly. But I don't know if that's ever going to change, to be honest with you. I don't know if that's ever going to change. There's not enough. There needs to be like a natural incentive to come in and transact beyond just I want to make money to really get true stability. If the market is all speculators, then that's kind of a problem too, right? You need to have a mix of different people to have a market that really works. Sorry, did I say something wrong here? I noticed another person or two stepped out, but maybe it was just a good stopping point. We are getting close to the end of the session, so, or when I step out. You seem to be clued up how the market works, but you say you don't make or expect to make money. Well, yeah, because I mean, like, here's the thing, Dande, is I've been doing this for 5 years. I know a lot of information about the market that 99% of retail traders don't know. So I have great knowledge. I'm really following the news. Okay, so I have a lot of advantages, right? Like myself, I know this is like super egotistical, but when I compare like my position to be able to make money in the market compared to your average retail trader, I think I'm really, really well positioned. And yet I know that here, through my best efforts, if I'm doing a really good job, I'm often just treading water. I'm not making millions of dollars doing this. That's for sure, right? So part of it is just kind of like accepting the reality of what it is, that it's really hard to make excessive amounts of money trading. And I think that the big thing is if you want to be the one that makes the millions of dollars, you want to be, you've got yourself well positioned, like I feel that I am, and then an opportunity comes along that's like really obvious and you're able to take full advantage of it. That hasn't happened to me yet, but maybe it will someday, right? But I just come in and I say, well, okay, it would be irresponsible. It would be fraud for me to come in and tell you all that, oh, you're all going to become rich doing this, right? This is just not the case. It's not the case. Somebody has to do it. But you're probably not going to make money doing it. The chances are, but the stat is 95% of you are not going to make money and give up at some point. It just so happens that those 5% of people that actually stick around, for whatever reason, they're too stubborn, they love it too much, or maybe they actually are making money, we have a higher percentage of those people here on this stream than you would normally otherwise have. And I'm quite proud of that. But it's not because what I'm teaching is like I've got this thing that really, really works, and yet no. It's just it's because we understand the mission, right? And the people that are able to stick around and be successful, they already understand that. And that's why I'm constantly talking about it. It's not because I want you to have no faith in it. It's not because I want to dissuade you from trading and convince you that you're not going to make any money. It's because I understand that the people that survive are the ones that have accepted that. Right? Believe in God might be sociologically good for you because people will hate you if you don't believe, but that's a totally different argument. Oh, no, I don't even think it's that. I think that humans benefit from... Oh, I didn't mean to switch YouTube channels? No, I don't know. I was just looking, we were like at one point we were at 20 viewers and it was like, it dropped really quickly, which was unusual. And I was like, was it something that I said about when I started talking about faith? They're like, well, I don't believe that. I'm going to tune out. I don't know. I think it was more that that's just the time that people tune out, but it was a little weird that how it went down today. There was a couple of new people here in chat today, so I was like checking myself. Did I say something stupid? I don't think I did. I think that I was saying stuff that was important. Anyways, all I'm not making an argument about, like, again, I can't empirically prove that God is true. Yeah, I think that you have to, if you believe in God, I think that you have to take the position that you believe it on faith. I mean, that's the way that it's meant to be. But to the non-believer, the argument that I make is you need to understand that faith is a fundamental function of human existence. You don't function without faith. So you might not have faith in God, but you have faith in things you don't even realize it, because you wouldn't be able to live. you didn't have faith. Otherwise, you would be frozen. You wouldn't be able to do anything. It requires faith to act. Most people laugh and make fun. Yeah, well, I don't know. It kind of depends on the crowd, right? You go on Reddit. Reddit really don't like Mormons. Far left really doesn't like Mormons, mostly because they think that it's their political ideology. It's really funny to me when you get groups of people, they'll hate another group of people because of their supposed ideology when it doesn't really actually match up. Like, probably the best example of this is in the crypto sphere. So there are a lot of people that hate Bitcoin, and they deride all Bitcoin owners as libertarian lunatics, right? That Bitcoin is a libertarian fever dream, and it's sucking in all of these clueless libertarians, right? Except for that the majority of Bitcoin holders are actually left-wing. There are more left-wing Bitcoin holders than there are right-wing Bitcoin holders. So that might be a function of just the age group, but that's what the stats say. That's what the stats say. So all of these people, they don't like it because they think that it's a libertarian thing when it's not. It's more a liberal thing. Maybe they shouldn't hate them so much, but I'm glad if you think that cryptocurrencies are harmful to the world in general, because that's the conclusion I've come to at the current time. Cryptosphere in its current state is a negative thing for mankind. Too much energy usage, too much fraud, inefficient technology. Something's going to come along, it's going to be better, and everybody will forget about it. I hope. We'll see. Well, so kind of interesting action here in the Treasury that there is absolutely no way I would have predicted. Of course, I don't feel so clued into the market right now. Oh, did we? So hold on. Did I miss something? No. I hadn't really been listening to my news clock here. So I don't know if there was like something an hour ago that was like critical that I missed. It's kind of curious to me how you had, well, I don't know, maybe it's not so curious. You had the big move down on the ECB thing, then after the press conference it recovered completely, and now since the S&P 500 has been trading, we've moved all the way back down to the low. So great if you're playing the range, but I don't think that I had
Russian oil imports
forces coming in predicting it playing out in that particular direction. So I'm glad that I didn't trade today. But that's just the way it is. I got to tell you, the biggest thing, once you got everything in, what went to the stage that I'm at, I think that with where I'm at right now, the most important thing for me is figuring out when to trade and when not to trade. I think that that's the most critical thing for me right now. It's understanding when I don't have the advantage in passing. It's really hard for me to watch it move and not feel like I should have taken a trade, I want to trade every move, but you really shouldn't. Like, sometimes you had no reason to think that was going to happen. All right. I've got to get going.
US House Speaker Pelosi is currently speaking.
But we'll see you guys tomorrow. Tomorrow's CPI. Don't miss it. Don't miss it. Yeah, I need to come in here. I didn't edit the ECB press conference. ECB decision day.
US House Speaker Pelosi says that lawmakers will take up the bipartisan bill to enhance Supreme Court security next week.
All right, see you guys tomorrow. Meantime, stay profitable, friends, or at least don't lose it all.